The broadcast is now starting. All attendees are in listen-only mode.
Hey, thank you for joining us today, and welcome to What Options Indicators Are Saying About This Market with Larry McMillan from the Options Strategist. Hey, I'm Ryan Redfern, the Vice President of NAAIM, the National Association of Active Investment Managers. Hey, I'm really looking forward to speaking with Larry today. Larry's a longtime NAAIM member, and I couldn't be happier to have him with us. What is NAAIM? It's an organization of investment professionals, mostly RIAs, money managers, and advisors who believe in actively managing market risks for their clients. It's a great resource for all things that you need to run a successful advisory business. Personally, for me, being a part of the NAAIM community has helped me improve so much of what I do. It's allowed me to grow my firm bigger than I ever thought I could. Even though it's not just the trading, it's everything from technology to compliance and networking and really conquering hurdles I haven't thought about yet. So it's a huge benefit for somebody like myself. So if you are or considering becoming a financial professional and you're not yet a member of NAAIM, we're offering $100 off membership today for those attending. That'll be in the handout section and information on the right side. You can get more info there. Also, after today's call, attendees will be sent a form for 1 hour of CE for the CFP designation. You also could get 1 hour of CE if you're a CMT market technician as well. But they self-report, so that'll be up to you. But look out for any information about that, or contact Susan at NAAIM about the CE for the CMT. If you have questions for Larry during the webinar, please type them into the questions panel close to the bottom of the control panel on the right. I think it also says chat or something like that. You want it to go to the questions. I will be fielding them, and I will get to them at the end of the Q&A at a session of the Q&A at the end of the presentation. All right. Okay, Larry, well, thanks for being here today, and it's all you.
Okay, Ryan, thanks a lot. So I've got a fair amount of material here. We're going to discuss the current market, which is very interesting at this time. The market's usually interesting, but it's especially interesting right now. Just a little background. We originally started out as a derivatives research firm almost 30 years ago. After I was running a prop desk on Wall Street, and we started out with selling data, research, newsletters, etc. But after the 2008 crash, we branched into money management, and so we're both a CTA and an RIA currently managing option accounts. And then we also do a certain amount of option education, such as mentoring, and of course seminars like this. Our managed accounts are up on the year. I mean, a lot of people, I guess, can say that now, but we were able to say that in March when the market was looking pretty rough. And our newsletters are having one of their best years ever. So if you are interested, we are offering 20% off on our 2 premium newsletters, Daily Alerts and the Daily Strategist. You can go to this link, and I'll talk more about that later. Let's get started on the actual seminar. There's 4 things I look at, but we're going to actually discuss a little bit more than just these things. The first is the chart of the S&P 500, which is the most important indicator of. If your indicators are all saying sell and the market's going up, then the market wins. So the chart of the S&P 500 needs to agree with other things that you're looking at. Also, we're going to look at put-call ratios, which are very interesting. Market breadth, and then several things about volatility, primarily VIX, but also the VIX futures and options. So there's an important rule that I live by, and that is oversold does not mean buy. So we started down this week. We already had one oversold condition, but in general, markets can become oversold and stay that way for a long period of time. On the way down in January, February, we got oversold maybe by February 27th or 6th, even just for a few days in. And obviously it stayed in a bear market for 3 weeks after that, a nasty 3 weeks. And there's a corollary to that. Overbought does not mean sell either. This market on the way up has been overbought probably for over a month, maybe 6 weeks. So if you had sold at the first sign of overbought, you would have been crushed. So again, we wait for confirmed sell signals, which we have a few of right now, as you'll see. So this is just a simple chart of the S&P 500, not too much of real note here, except for the fact that the old high was here at 3,400. We met some resistance there, and then when we broke on through there, that was that last huge push to the upside. On the way back down this week, it did not really find any support at 3,400, which is, I found a little bit surprising, but we did bottom out right around 33.20, which was also a minor support area from back a couple of weeks ago or a month ago. And today's rally, which was very strong, and I think we're in for another period of volatile moves back and forth, went back above 3,400 a bit, and we closed right about on 3,400. The next support level down is this one that was the July highs at 32.80, and I think that's a pretty important one because you can still bounce off of here, and the chart wouldn't look too bad. If you step back and look at the chart, it's still trending upwards, and it wouldn't be a big problem. But if it starts to break another trend, then that's going to be worse. So if it breaks down below here, and then of course there was this support at 3,200. I think by the time you got there, though, you'd have to say the chart had already turned negative by that time. Now, I always show this chart, not always, but recently I've been showing it. It's the rallies during the Depression bear market of 1929 to 1933. And the first one was really probably the most significant. The crash of 29 happened right in here, went to a little bit lower low, and then rallied 48% off that low over a 6-month time period. And while that happened, realized volatility dropped to extremely low levels. Things like AT&T went to new all-time highs, which was a bellwether stock back then. And it really looked like, the worst was over, and of course it wasn't. But it didn't really fall to a new low until October of 30. So it was a whole year later before that low was broken. So I'm not saying we're necessarily going to test the March 2020 lows, but I'd say you're really not out of the bag until a year's passed, anyways, at least from this one example. So I'm not going to dwell on this. I'm not predicting a return to the lows or anything like that, but I'm just using it to show that it is possible, even though from the viewpoint of being in a very strong rally, it probably didn't seem like it in April 1930 that 6 months later they could be back at the lows, and it doesn't seem like that now. But we don't make long-term forecasts like that. We just stick with our indicators. So right now we have support at 33.20 on the chart, and then the one I identified as, to me, the more important area, 32.80. 3,200 is also support, but I think if we break 32.80, there's going to be a lot of problems. On the upside, I kind of tentatively said there was resistance at 3,400. I guess not really. We kind of sliced through that, both going down and up. But the all-time highs are there at 35.90. Obviously, I think if we got back to then, even at 3,400, I think a lot of people might be saying, after looking at where they were a day or two ago, saying, well, boo, I'm be glad to get out just there, get out even or halfway close to even. And that's what creates a resistance area. When people get back to that area, they say, well, oh, I'm lucky I got back here. I learned my lesson. I'm getting out now, and they sell. As I said, a close below 32.80 would be bearish. But right now, the overall impression I have is that the S&P chart is still clinging to a bullish uptrend, and therefore you need to take that into consideration when you are trading other sell signals, which we are. We're not going crazy on the bearish setup yet, as long as the S&P chart still remains positive. All of our signals have stops on them anyways, but it probably makes a difference in what quantities you're putting on. There's another thing we look at. I call it modified Bollinger Bands. When John Bollinger invented Bollinger Bands, he needed a definition of realized volatility, and for that, he used the standard deviation of daily closing prices. And, I think that sounds pretty good. I mean, I'm a mathematician. I've got a couple degrees in that area, and I still thought that sounded pretty good. But Black-Scholes and other high-ranking mathematicians disagree. They say that the standard deviation of realized volatility should be the standard deviation of daily percentage price changes. So this is what's used in the Black-Scholes model. that calculate the volatility is used implied and historical. And so we are bound as an option firm to using this. I mean, there are other models besides the Black-Scholes model, but that's definitely the premier one, the one's used most popularly on all the option trading platforms. And if our data didn't agree with that, it wouldn't make any sense for us. So using that definition, we draw plus or minus 3 and 4 standard deviation bands using the Black-Scholes volatility around the 20-day moving average. And when the market moves outside the 4 sigma band and then back inside the 3 sigma, it gives us a signal. So we've had some really nice signals over the years, but in the last couple of years, we've had a few too many false signals. So I created a thing, a system we call it McMillan volatility bands, MVB for short. And that MVB just gave a sell signal. So let me show you a chart here. This is the S&P again, but now those bands are drawn around it. So for example, this band right here, that's the plus 4 sigma band. This one is plus 3 sigma. So you can see right here, we moved outside of 4 sigma, then inside of 3 sigma. That was a sell signal. Interesting to note that the market, this is in last January, the market went down just a little bit and then went to new highs. But these sell signals stay in place unless the market moves back outside the 4 sigma band, which is right here. It did not do that, so that sell signal was still in place when the market broke down. So the red letters on this chart are buys and sells that were successful. The blue ones are ones that were premature. So for example, you can see we came out here, went in, and then came back out again. That stops you out, but sets up another one. So there were, on this chart, 5 premature signals. And so that's why we created this further condition that we're now using. So for example, these purple or pink or whatever they are, bands over here, there's one, and now this one. Those were setups, but they did not follow through. We need further confirmation rather than just closing inside the 3 sigma band. Using that system, all but one of those previous premature signals would have been avoided. So we avoided 2 of them there, but now we have one. We have a sell signal here. And we gave it on a close, we had 2 conditions. Either was a close below 3,400, which we did again today, close below 3,400, or trade at 3,350. So both of those were satisfied, and therefore that gave us a sell signal. Just as an aside, we are selling these volatility band indicator as an add-on to free charts at tradingview.com. So if you're interested, all you have to do is create a tradingview.com account for free, and then you come to our website and subscribe to the McMillan volatility bands, and give us your account ID, and then you're ready to go. So when you draw a chart on TradingView, it will show you the band buys and sell signals, and it also will email you every day the setups. So there's the S&P chart, and there's that last sell signal that just occurred there, the little red arrow. You can see that this one only gave 1 buy on the way up. This was the premature sell there, and just 1 sell before. So fewer signals, but hopefully better ones. Anyways, moving on, the next thing we look at is put-call ratios. So put-call ratios were invented as an indicator by Marty Zweig in the 1950s. And he would take the option volume out of the ads that ran in Barron's. Each put and call dealer in those days would, they'd trade just a few hundred options a week. They might trade, 800 calls and 600 puts or something like that. And they'd put that in their ad. And he started adding them up, and he noticed that if there was a lot of calls trading versus a lot of puts trading, way more calls than puts, then the market suddenly went down after that. And conversely, when there were a lot more puts trading, the market went up after that. So it's a contrary indicator, and we'll get into the actual calculation of it in a minute. But we use the equity-only put-call ratio. In other words, all stock options that trade. So there's millions of these trading every day, and we use that to predict the broad market. So Marty's theory, of course, too much put buying is, everybody's bearish. They're all lined up on the bearish side. It's time for us to do something bullish. Conversely, if everybody's bullish, which there's been a tremendous amount of call buying in the last few months, then you should be thinking about doing something bearish. So simplistically, let's say it's IBM. At the end of the day, we sum up the volume on all the puts that trade in IBM. Separately, we sum up the volume on all the calls, and it gives us the put-call ratio. So since puts are in the numerator of that fraction, heavy put buying will drive the ratio higher. But when are you likely to have heavy put buying? Well, that's when the stock is going down, right? So they move opposite direction. Same thing on calls. Since calls are in the denominator of the fraction, heavy call buying will drive the ratio lower. When are you likely to have heavy call buying? Well, that's when the stock is going up. So obviously, we're going to be looking at a sort of inverse chart here. We keep a moving average. I use 21 days on these put-call ratio charts just in case there's something to Fibonacci. So this is ideally the way things should look. The stock price and the put-call ratio should be a nice inverse pattern to each other. It works like this. Let's say that the stock is going down. So while that's happening, people are buying puts and making money on those puts. The public is right during the trend. But then you eventually get over here, and people have pretty much bought all the puts they want to buy. And so you get a local maximum on the put-call ratio chart. A local ratio chart is a buy signal for the stock. And then the stock should take off to the upside, at which point call buying kicks in and forces the ratio lower and lower and lower until finally the call buyers are sated and the put-call ratio makes a local minimum. And a local minimum on the put-call ratio chart is a sell signal for the stock itself. So that's how we interpret these charts, and I'm going to show you both index and futures and stock charts all along the way. This chart is not current, but on the top is the S&P 500 index, and on the bottom is the equity-only put-call ratio, again, all stock options that trade. And you can see the inverse symmetry that exists most of the time, and that's good. And that's why we use the equity-only put-call ratio to predict the stock market. So here's the current situation. We had a huge amount of buying of puts in March. That forced the ratio up until it finally made a local maximum as a buy signal. By the way, that was the highest put call rating that we had, 21-day moving average in history. Our history goes back to 1993, and it was at around 100, which means that 100 puts were traded for every 100 calls. Now this is in stocks only, not futures, not indices. That's very unusual. Typically, many more calls trade than puts. So we have a computer analysis program that's based on a chess tree probability, sort of constructing a tree of probabilities. And it quickly told us about 1 day later, I believe it was actually March 24th, that was a buy signal. You can see we had a little wiggle up and down right there. Did that say, cancel out the buy signal? No, the computer analysis program said stick with the buy signal. We did. It came all the way down here. It had a little slight rise there, but then another fall. So I make that little, we did not take a trade based on that little slight rise. I was looking for a much sharper rise. And then it went lower, again, a slight rise, and then lower again. So it got down now to the lowest it's been since 2000. And back then, I mean, it was routine for the put-call ratio chart to be in the 40s. But, now, 20 years later, it's not. It's extremely unusual, and I really would have bet you would have never seen this. So we've had so much call buying that on average we were getting down here where there were only 40 puts trading for every 100 calls. So that's not very many, and of course that's extremely overbought. But overbought did not mean sell until this week. Now it's curled up here, and we are calling that the sell signal. So are the computer analysis programs. I'll show you a couple of other charts that are similar in just a second. The total put-call ratio, which is equity plus index, that also reached the lowest level that has been since January 2004, so 16-year low. In other words, low means people are buying calls, people are extremely bullish. The CBOE publishes their own equity-only put-call ratio, only using options that trade in the CBOE. Our other data uses all options traded on all U.S. exchanges. This got it's at the lowest level, or was at the lowest level that in our data, I only have that going back to 2001. So everything here was showing extremely overbought. But as we said, overbought does not mean sell. The sell signal required that these things turn upward, and they did turn upward. And so if they go down and make a new relative low, then that would stop that sell signal out. Otherwise, that sell signal is in place. As computers came into use, we were able to calculate a more sophisticated put-call ratio, measuring the dollars being spent on bullish opinion versus the dollars being spent on bearish opinion. So at the end of every day, we calculate the dollar volume of an option, which to us is its closing price times the volume it traded that day. You could do this on a real-time basis. That's an expensive data set. And when we tried to use that for a while, it cost a lot of money. It tied up a lot of computer power. And it wasn't giving us any better results than just using the closing data. So we use the closing data. So we make this calculation for every option, say again on IBM, and then we sum those up for all the puts, and separately we sum them up for all the calls, divide the true, and that's the weighted put call ratio. And again, we keep the 21-day moving average, et cetera, et cetera. And so here's how that chart looks. So it made the same high back there on March 24th, gave us a buy signal. That had been the highest reading since the crash of 08. So in 08, it got to, it's a little bit higher than that, but let's just say it's extremely pessimistic. A lot of puts were trading. And you can see here it's got near 200, meaning $200 were being spent on puts for every $100 being spent on calls. So that's a lot. So now we've come down, and this one really didn't give any fake outs, maybe that little thing right there, but the computer programs were saying, don't worry about that. And now this week, it has bottomed and started higher. Again, this is from the lowest level in 16 years for this one, since 2004. Again, a crazy long time ago. And so very, very overbought, very, very many people buying calls. I'm sure you've read the articles about the traders at Robinhood or the shenanigans, this week by the Japanese company. All these SoftBank, all these things were contributing. But now it's heading in a sell signal until it rolls over. So I said if it should roll over and go to a new relative low, break that low, then that would stop us out. Otherwise, this sell signal is in place until this happens somewhere down the line. So just to summarize here, we've got these new sell signals coming from extremely overbought levels. In general, those should be good sell signals because the market was so overbought, but every market has its own characteristics. So we'll play them straight and not get stuck in them. If they go to new lows, then we'll stop out. Those buy signals that came in March were near the S&P lows, of course, and came from extremely high oversold bearish readings on the put call ratios. And back in January, the sell signals were excellent but premature. Let me just back up just a second just to show you that, because I didn't really discuss that. In January, we came down here, we got this sell signal. And you can see it occurred in mid-January, about where that sell signal occurred for the modified Bollinger Bands, by the way. And we did get this little sell-off from there, but then the market went to new highs. However, this did not go back to a buy signal, just traded sideways for a while and then broke. When the market broke in late February, it just kept going higher. So that sell signal was still in place for about a month before the market actually broke. I'm not saying that's going to happen right now, but if it were to happen right now, just be aware that that still sell signal would still be in effect as long as it's there. So based on this signal, we just recently bought some November put spreads to play it. Okay, let's get back where we were. So, this whole thing with the put call ratios has been a classic example of overbought does not mean sell, because if you've been reading in Barron's or anywhere else, I've been talking about the massive amount of call buying that's been, all these retail accounts have been opening, blah, blah, blah. And, your initial reaction might be, well, that's the end of it. I'm going to sell here. But no, it wasn't the end of it. We're not even certain that we've reached the end of it now, but we're a lot closer. I feel a lot better selling here than I would have 6 weeks ago, that's for sure. So what do we actually trade when we trade? I'm going to talk about calls here, but we're trading puts now, essentially. So we look at the delta of the option. The delta of a call option ranges between 0 and 1. It's the percentage, basically, of the stock move that the option captures. So if it's 0, the option is way out of the money and just isn't making any move at all, even though the underlying is moving. If it's 1, the option is way in the money and is completely behaving just like stock. So when we start out in a new position, I'm trying to predict where the S&P 500 is going, SVIX or SPY or the futures. I'm not that concerned about the option because I know if I buy an option with a high delta, it's going to perform like the underlying. It's going to behave like the underlying, and that's what I want. I'm not going to buy some low delta out of the money speculative option. I mean, you see this happen all the time, more to beginner traders than the professionals, but they'll have an opinion, they'll buy an option that's way too far out of the money. Their opinion is right, the stock goes up, it just doesn't go up far enough to save the option, and they lose money instead of making. So we buy in the money options, typically with a delta of about 0.70 or higher. On the put side is minus 0.70. And we would, so typically on a SPY trade, if we're in for 2 or 3 weeks, we might buy an option that's slightly in the money. On the other hand, if we're in for a longer period of time, we might go with an at the money option with a delta, let's say of 0.55. That's typically what a call option has at the money, because here we're balancing the risk of spending more money on a longer term position with, I still want some responsiveness, 0.55, 55% from the option. Now, do we spread? So if you watch TV, you see these guys, the option traders that are spread every trade they make. I mean, that's crazy. That's silly, and it's really not very smart. You should only spread at one time, and that's when the options are overpriced, because then you are getting a benefit of, if the options go back to fair price, your spread can actually widen just because of that. So I don't want to cut off my upside, so I typically don't spread unless the options, as I said, are really expensive. Now, someone else always says, well, you're risking more money. No, you're not. You're risking 100%, whether you buy a vertical spread or you buy the option. It's 100% risk. So if you're concerned about dollars, then buy a few less dollars of regular outright options than you would have bought dollars on spreads, and you're still risking the same dollars, and then you don't cut off your profit potential. But when options are expensive, typically when volatility is high, and this could be, right now VIX is very high, and so options are on the S&P and really around everywhere are pretty expensive. So this is an ideal time to do bull or bear spreads, depending on your opinion on S&P. But in March of 2020, any bear spread you would have put on was really suboptimal because it fell so fast it just blew right through your short strike. You'd prefer it not to blow through your short strike, but there are ways you can counter that. For example, if it does get to your short strike, they'll roll the whole position. So like right now, maybe let's say you buy some SPY closed today right around 340. So they say you bought some 340 call puts, and in the puts now we're doing our short side 25 to 30 points away. So let's say you bought a 340 put and you sold a 310 put on S&P on SPY, and then the market collapses and it goes through 310. Well, you could take this one off for a profit and set up a new one. Buy the 310 and sell the 280 or wherever prices are dictating at the time. So you want the spread to be wide if volatility is high. Volatility is high, so the spread is wide. Now you notice here I would say it's less wide for calls, because if the market starts to go back up, volatility typically will fall, although again this year is a little bit odd with that, and we'll talk about it. But it's wider with puts. In any case, let's look at some individual put-call ratio charts. Now, we make a slight distinction here between what I told you before. Every local maximum, every local minimum is not a buy or sell signal on an individual stock or futures put-call chart. Rather, we look at the history of the put-call ratios, and we want the signal to be coming from either the 10th percentile or lower, that would be a sell signal, or a buy signal from the 90th percentile or higher. So what do I mean here? Well, let's take Let's take this one right here. It's a local minimum. Well, first of all, let's just take a look at this. Here's a local maximum. But that turned out, you can't see back 600 days, but if you went back 600 days, that put call ratio level there of like 51, that's right in the middle of all the other put call ratios. Nothing extreme about it, and so we don't take that signal. But now we come down here, we get this one, and this one was low at the time. It was near the 0th percentile, so we did try to buy puts there. That didn't work. Then it came lower in February, and often when I've had a failed signal, I don't really feel that great about jumping in again, but this was at 20. Now this is a weighted ratio, so this is dollars. So $20 were being spent on puts on Microsoft for every $100 being spent on calls. I mean, that's crazy. You don't see that very often. So we looked at that chart. There was a little support level right there at 192. We said if it breaks the support, go ahead and buy puts. So we rode the puts down. Unfortunately, I didn't take this next buy signal, which was excellent. And that also was in like the 100th percentile, so that qualifies as a buy signal. It actually kind of got away from me by the time that the computer program said, yeah, this is a buy signal. We were about 5 days into that rally, and the stock was really up quite a bit. Anyways, we've messed around, and now just recently it came all the way back down here, formed a local minimum down in this is about the 8th percentile of the previous 600 days reading. And so that's a sell signal. So we recently bought, I believe, a put spread on Microsoft. This is the Russell 2000, same sort of thing. Just recently gave a local minimum, which is a sell signal. And it was also in a low percentile, like the 8th percentile. You can see there were 2 other good sell signals on this chart, and then that one was not. So again, the red letters are profitable signals, the blue are not. Medtronic gave us a buy signal not too long ago, and then broke out to the upside after it did that, so that's good. And it's pulled back a little. This chart is current, even though it doesn't show the September on the scale. This chart is current, so it's pulled back a little, but we still have the buy signal. The way I treat these is, once they're on the signal, then I don't really trade the chart so much of the stock. I just watch the put call ratio buy signal. So you can see that it did form. It might be forming a little local minimum there, which would not be good. But so far, the put call ratio analysis programs have not said that that's actually a sell signal. But if that did become a sell signal, and we wouldn't take a sell signal that high in the chart, but we would use it, let's say, to stop out a long position. We can do this with ETFs. This is UNG. We just had this one recently. Came down here, and the put call ratio reached the lowest level that it's been in 600 days, so the 0th percentile, and then turned upwards. And we said if it breaks 13.5, which it did yesterday, I believe, then we bought puts. So we're now long puts on UNG. And that's using the UNG options themselves, not natural gas futures options. But we do use futures options sometimes. This is cotton. So the chart on the bottom, the put call ratio chart, is actually drawn using the put call ratio of the cotton futures options. Now there is an ETF, BAL, that trades on cotton. And so you could trade BAL, but this chart is based on cotton. So you can see it gave a really nice buy signal there, a really nice buy signal there, a really nice sell signal there. So this is one to keep an eye on. Now we're cutting down, it's kind of moving sideways. Although I do believe that cotton had another attempt at a breakout today. But so we started using a trailing stop here now because this has gotten so low and it's getting pretty overbought. And one of the days it's going to turn up and give us a new sell signal. Similarly, cocoa has had some great signals, and we're on a long there. We just rolled our long calls up. And even though cocoa itself, and there is a ETF for cocoa as well, NIB. Even though the stock backed off a little, futures backed off a little, the put call ratio is still declining, still strongly on the buy signal, so we're still staying with it. We roll up to higher strikes in any cases where we have some nice profits. That just takes a credit, puts it in your pocket, and you don't have to worry so much about a pullback wiping you out. Coffee also has been very good, and it's probably getting a little long in the tooth here. This sell signal was actually not in below the 10th percentile, even though this one was, but there were enough data points down here and elsewhere that this was no longer below it. Now, however, we're getting back down to the case where we're getting below the 10th percentile. But right now, I mean, it did pull back finally today some, so maybe we're reaching the end of this one too. All right, so the next area we look at is market breadth, and there's two things you can do with breadth. You can keep a total, cumulative total, or you can plot an oscillator. So we have an oscillator that we created years ago, and the oscillator is strictly computed as 90% of yesterday's oscillator value plus 10% of the difference between today's advances and declines. Now, we keep two forms of it. We keep the New York Stock Exchange, which is typical. Everybody keeps that. But there's things on the New York Stock Exchange that are not stocks. So we also keep a stocks only. And for us, stocks only means all optionable stocks. So we're looking at the set of, well, over 5,000 stocks that have listed options on them. And we compute an advanced decline line and everything else using that. So here's the oscillator of the stocks only breadth oscillator going back to 2013. And the market's been going up most of this time since 2013. So we only have a few oversold conditions here, these green lines probing down here. And we did get an extreme oversold right before Christmas in 2018, which is a very nasty market. And then this year in March, we just went a little bit below it. So first, this was the most oversold in history, and now this was. But again, oversold does not mean buy. We wait for it to stop being oversold, and we buy there. So back here, I know that was around January 8th. This time it was even a little bit earlier, but I'm going to say right around the end of March. Maybe we'll say April 1st, something like that, but still very strong. And what happens after that, then you typically get into a very overbought situation. So this is probably the biggest, widest overbought area that we've ever seen. And, this little comment at the bottom here, other technicians who follow longer term trends, that's not me generally, but they were saying that, that kind of extreme overbought means that the market should have a really good rally for a while, and it did until this year. Now we came back down and, got these buy signals, and then we went, again, overbought. And even though that particular reading right there was the most overbought we've ever seen for, this oscillator, it still wasn't the kind of big, wide, dark red area that you had there. And so I found that, here, look, we were at a new all-time high right then, and breadth was weak. And again, this time you were at a new all-time high right there, and breadth was weak. So that, in the long run, that's not good for the market. In the short run, anything can happen. So as of yesterday's close, September 8th, we were oversold again. I'm pretty sure we popped through that today. Advances and declines were about 3-to-1 advances. So we might have a little short-term buy signal off that very oversold indicator. These flip back and forth pretty quickly. We got the sell signal on September 3rd, and as I said, we already were oversold. And as I pointed out, breadth did not expand back in January, and again, this oscillator, and again, did not do so in August. Now, I'm not going to go into too much on the cumulative advanced decline line, although we did write about it in our newsletter a couple of weeks ago. And the best thing about the cumulative advanced decline line, the best use of it is as a negative divergence. So for example, in January, both the S&P and the cumulative advanced decline line using stocks only data and New York Stock Exchange data, they all made new all-time highs together. Then the advanced decline lines began to fall off over the next month while the S&P went on to new all-time highs. So about a month later, you had a divergence, pretty obvious divergence between the two, and we saw what happened. That same thing was in place right now. The last time these cumulative advanced decline lines made a new all-time high was August 12th. The S&P made repeated new all-time highs all the way up through September 3rd or 2nd, whichever it was. And so that's a negative divergence. Again, a negative divergence to me is not a sell signal, but it's a warning sign that sell signals are coming, and you better act on them when you get them. So we're acting on them. We've got some, VIX, let's move on to VIX. There's a lot There's a lot of silly things. I don't silly. There's a lot of crazy things going on with VIX, things we've never seen before. I mean, I think our firm is right up there at the top of volatility derivatives research and application. I mean, we made a lot of money in March, all with volatility derivatives, and yet this current VIX market I find somewhat confusing. So let's take a look. There's two things that are important about VIX. First is the trend of VIX. Should be trending opposite to the market direction. And the second is that on the VIX chart, spike peaks are buy signals, short-term up to like 1 month buy signals for the S&P. This isn't the case now, but VIX does sometimes get overbought when it gets very low and stays there for a long time. But it's not really a sell signal or bearish until it breaks out of that low area. So again, an example of overbought does not mean sell. So here's the VIX chart going back about a year. And all those B's on there are VIX spike peak buy signals. We have a system we built around this, a very specifically hard system that has exact parameters to it. And you can see that most of the letters are red, meaning they were successful. So a few clunkers in there, but we just had a buy signal here on September 4th. So index got up to almost 38, and that day closed just above 31. And even though it kind of ran up and back down the next day, that buy signal was still in effect because it didn't go higher than 38. And now today, we closed at 29 or so. So that, I don't have today's chart up bar on there. Looks like that. So that buy signal just happened, and there, unless we have stop out rules, but it could last for up to a month. So a little bit counter trend. So we take signals on both sides of the market. I mean, we have systems. Our systems have good track records. I can't tell which one's going to be a good trade, which one's not. Sometimes both can be. For example, you can see there was a buy signal in this thing in late January, and the market rallied quickly through the rest of mid-February. We were able to roll those long calls up, and we made a profit on that buy signal, even though within a month the market actually broke down, and the sell signals that had come in January were all working. So both things can happen. Now, I talked about the trend of VIX. There's two things we look at for the trend. This is the 200-day moving average here. This is the 20-day. So the trend to me is defined as being when VIX and the 20-day are both on the same side of the 200-day. So you can see right here, VIX was below, and so was the 20-day, and then they both broke out above right there. That was February 21st, before the market broke down, a day before, but still before. So that was a sell signal, major sell signal. Now you come back, we've finally got the other thing happened here, the 20-day and VIX crossed below the 200-day, both of them in late July. And of course, we had a real strong market rally since late July. Now we've kind of got a conundrum. VIX is above it, and the 20-day right here is below it, although you can see it's aiming higher. So right now, I would say off of that, I don't have a trend signal in VIX. But if that 20-day crosses above and VIX is still higher, that would be another sell signal. So, but if VIX comes back below, then that will, make the trend of VIX bullish once more. So that one's up in the air at the current time. Stay tuned. So just to summarize there, we're on a new spike peak buy signal. VIX and the 20-day are on both sides of the 200-day, so that's inconclusive. So all I can say is that the VIX chart is bullish in the short term because of that buy signal. Now, we've done some work, and I published an article on this last week. This is the composite pattern of VIX in election years. And we also have, of course, the composite of VIX in all years. And it looks a little similar, but there's one difference. First of all, that chart didn't have that big high A on it way up here until this year. VIX went to 90 this year, so that dominates a lot of the other ones. But that's not really what I'm talking about. I'm talking about this. VIX typically reaches its low right around the end of August or beginning of September in an election year. In other years, it does that more towards the 1st of July. And of course, we're only working with 9 data points here, so I may be oversimplifying it, But this year, if you look at the chart of VIX, it started to rise on August 27th, or if you want to say August 31st, when it kind of broke out above 25, and now it's been rising since then. So right in line with the pattern. So if you think about it, VIX came down, and I don't have a scale on this chart because I don't want you to think about it in absolute terms, just the pattern. So we just started to do this right now. We might maybe right there. If we're going to go to here, and again, the election does drive volatility, and this one is really driving some crazy volatility. Do we want to buy VIX on a pullback? And so my answer is yes. So we are going to be buying VIX derivatives on a pullback. If you could pull back to his 20-day moving average, we're going to buy VIX, even though it's pretty high right now, but you can see the pattern. So again, no guarantees, but it certainly has looked that way in the past. So another thing we look at is what I call the VIX Futures Construct, and that's the relationship of the VIX derivatives to VIX itself. So typically VIX futures trade at a premium to VIX, and the term structure slopes upwards. By that I mean, September would be futures price here, then October, then November, then December, with VIX down here somewhere, and all of that's bullish for stocks. When you get that pattern, that's bullish for stocks. When the opposite happens, is bearish, and so this was certainly the case in the bear market earlier this year. You had March futures here, then April, May, June, and the term structure sloped down, and VIX was way up here somewhere. So the futures were at a discount, and the term structure was sloping downwards. So here's the current one. I took a snapshot this afternoon, about maybe 2:30 in the afternoon, and when VIX was 28.79, let's see, VIX closed right almost there, 28.81. So these were the futures prices. And so here's September. So if we take the futures price minus the price of VIX, we get 29-cent discount. So the futures are a little bit of a discount. That's a little bit bearish. But then these October futures are crazy amount higher. They're at a $4.51 premium to VIX. But then after that, you see how the futures all slope down after that, all in a direct line. So the perfect sloping downward pattern here, that's bearish. But this thing is in the way. I'm just going to say it's in the way. You can see these futures are all trading at discount to VIX. These are not. But what happens is, if you think of it as a string attached between here and here, if I press the string up there, it's going to make these things come up with it to a certain extent. The string staying intact, of course. And why is that so high? Because the way the VIX futures work, October futures are based on options, SPX options, expiring 30 days later, or November 20th, after the election. And so when an event is occurring, or whether it be earnings or FDA, a PDUFA hearing or something like that, or an election, the options expiring after the event are going to be very expensive if you expect the event to be volatile. Obviously, the conglomerate option market does expect this to be a volatile event in the election. Not so convinced myself, but I'm certainly not going to take an opposing position necessarily. So that's what's going on, and there's what I call the poor man's term structure. By the way, you can get VIX futures by just going to cboe.com front page, homepage. On the upper right-hand corner is all the volatility derivatives on I believe a delayed pricing feed. But the CBOE also publishes these volatility indices. So we know that VIX is a 30-day index. They publish a 9-day, a 3-month, a 6-month, and a 1-year. And they used to have different symbols, but now they have these symbols. It kind of makes some sense. You can see here this slopes upwards through 90 days and then goes down a little bit. Why this slopes back up again at 1 year, I'm not really sure. But in any case, that's not a continuous uniform pattern either. It's got that distortion in there caused, again, by what's going to happen at the election. So, I mean, just to to sum these up, that most of these near-term futures are at a premium, but that's because of the election, and term structure then slopes downward. So it's a mixed term structure. I'm going to say it's slightly bearish, and I'm only saying slightly bearish because that term structure slopes downwards below where September is right now, you know, going out in time. So that's usually not a healthy sign for the market, but we normally can trade that, and I'll show you how in a minute. But just to summarize the market opinion, so just a review on the charts, the S&P chart is still holding onto a bullish pattern, but there is that new sell signal on the volatility bands. Put-call ratios on sell signals. Brent oscillators were oversold, probably gave a buy signal tonight. That's a very short-term thing. VIX gave a short-term buy signal as of the close on the 4th. And then the volatility term structure, as we just saw, is modestly bearish. So I can't really turn 100% bearish until SPX breaks that chart support of 3280. So we're trading signals in both directions. As you've seen, we have several signals on the sell side, really only the VIX on the buy side, but we are trading them all. Now, I know about a month ago or so, there was a NAAIM seminar on, you know, what people did during the crash to make money, the crash in March, and we use what I call the VIX SPY hedge. I'm not going to go into a lot of detail about it here, but I'll just describe it. During any market crash, a VIX futures traded at a big discount to VIX, and so that discount has to disappear by expiration. So you'd like to buy those VIX futures at a discount. All right, fine, be my guest. But you know, where you just long that VIX futures, that could be a dangerous position. So you need a hedge. And the hedge is to also buy the market. Remember, they move opposite to each other. So if I'm long VIX and I'm long the market, then the two sides will offset each other, but I've got this big discount in the futures that's working in my favor. And typically the ratio is, if you're using options, you buy 2 VIX calls to 1 SPY call. Now, just recently, the CBOE listed VIX mini futures at $100 per point instead of $1,000 per point for the old ones. And the CME already has the micro S&P futures trading at $5 a point. So you could get into this hedge pretty cheaply. You know, it's still a few $1,000s of margin, but you would buy 2 of the VXM futures and buy 1 of the MES, the micro futures on the S&P. Now, more recently, what I call the reverse hedge has set up. In other words, sometimes the premium on the VIX futures is very large. It's not a discount, it's a premium, and that's what we're seeing right now in October VIX futures. I just showed you that. So as we get closer to October expiration, which this year is October 21st, that premium will have to disappear, because on the last day, it's going to have to trade where VIX is. So there will be a point here where we'd like to sell both sides. Again, that's an offset. And because we're at a premium, we're selling the expensive futures, and then we hopefully capture that premium. You're kind of far away from that now. Still, you're 6 weeks, 7 weeks away from October expiration. That's really too far in advance to play that, unless the premium gets crazy. I mean, I say last week, it might have gone up to 7 or 8 points. Now it's like 4. But in any case, that's something we'll be looking at. And there's some other things you might want to watch out for. We have an indicator that says if new lows outnumber new highs after you've been in a long period of it being the other way, that's a sell signal. I'm kind of throwing in the condition now that you want the number of new lows to be significant, you know, like say above 80 or something. And for this, you can use New York Stock Exchange data, which you get right off the Wall Street Journal website or the New York Stock Exchange website. So, you know, that's another sell signal that's setting up. And this is another sell signal that occurred. The historical volatility of the S&P 500 fell to 8%. And when that happens, that's, again, an overbought condition. And when it rises above 10%, then you have a sell signal. That happened on either last Thursday or Friday. So this sell signal is also in effect. And then finally, we had this huge difference because of the premium on the VIX and OCC futures, that the VIX, well, I call it the blended futures contract, and the historical volatility, which here was down to 8%, got to an all-time premium. Here's a chart of that. You can see over on the right, it got up to the highest level it's ever been at. The previous high was back here in 2009. And you know, it's hard to base a market indicator off one data point, so I'm not really saying it was a sell signal, but I don't think it can be interpreted as a buy signal, so whatever. It's currently back to 10 now, so that's sort of high. I mean, you see it hasn't been above 10 a lot in its life, but that's not nearly as rare as it was when it's up almost to 30. And then finally, I want to just finish up with some real history here. So this is the historical, actual, realized volatility of the Dow Jones index from 1928 to the present. So you, on the right-hand side of this chart, you can see that this 120 means the historical volatility got up to 120%. So here in the crash of 29, it got up to about 116%. In the crash of 87, 116%. This year, it got up to, I believe it was 106%. So some crazy numbers. I mentioned that rally in 1929 through 1930, that 6-month rally that took the market up into April of 1930. Historical volatility fell to 8%. 8%. And remember, I just told you we had a sell signal when it went back above 10. So we just got that sell signal. Is it going to be that big? I doubt it. But let's just say that volatility was a major contributor to what was going on back then, and it completely had disappeared and then returned with a vengeance. And so then, you know, other bear market years, the last time volatility got really high was there. And this is, again, realized volatility. It got up to about 44% when it looked like the English were going to lose World War II to the Germans. We were in yet at that point, got up to 44%. After that, it never got above there again until 1987. Now, since then, it's been above there several times, not a lot, but several times, you know, as things have happened. And so we're a more volatile market now than we were there for the, you know, 40-year period, 40-some-year period between Dunkirk and the crash of 87. Now, if we put implied volatility on top of that, VIX is the orange line. And you can see that the orange line is above the pink line almost all the time. And that's why you have these guys running hedge funds and everything else that are selling S&P premium, because the S&P premium is the orange line. And what really happens 20 days later is the pink line. And so you're almost always selling something that's more expensive than it is priced to be more expensive than what it turns out to be, except when the market crashes. So you have to be able to stop that strategy, have ways to get out of it. I mentioned that we manage option money. That's what we do. We sell this premium most of the time, but then we switch to a long volatility strategy when we need to. And so if you're interested in our money management, you know, give us a call. So that's going to conclude things. Before I give it back to Ryan for questions, let me just mention once again, we are offering 20% on our 2 premium newsletters. This is the daily volume alerts. I write this one every morning. And we not only trade all these signals that we've talked about here, but we also trade some takeovers. And so we use option volume as a sort of indicator where takeovers. 20% off, just go to this website. We also have the Daily Strategist. This comes out twice a day. In the morning, there's a market report, and then in the afternoon, a volatility report. Again, all of these same indicator strategies plus some more relatively sophisticated strategies based on option pricing, such as, you know, like option buying on straddles, let's say, or selling naked puts and things like that. You know, the whole gamut of strategies. This discount is good through next week, and again, same website. Also, we do have a series of Saturday seminars going on. Our next one is coming up on the 18th of September, and they're all recorded and will eventually be sold as a big CD or something. But if you're interested, I invite you to that. And I record a YouTube market comment every Monday as well. So that's basically it. That's my contact information. You want to get a hold of me for anything. And Ryan, why don't I shoot it back to you if you have any questions there?
You got it. I've got a few. This one was last, but I thought it was interesting. I wish some firm would create an ETF that tracks the VIX very closely and would not have the extreme downside drift that VXX has. Technically, is it not possible to create an ETF that would track the VIX closely?
Right. Technically, it's not possible. Okay,
Right.
otherwise, they would have done it. The reason is VIX is a very complex formula, and it uses the entire strips of options, all options with a bid and offer, so way, way out of the money, 100 strikes maybe or more. And these are S&P options. And it uses the 2 months, the 2 strips that most closely surround the price, the 30-day window looking forward, and then the weighting changes every day. So if you think about trying to duplicate that, you'd have to take a position in hundreds and hundreds of striking prices and then alter your quantity in them every day. It really, I can't be done. I mean, some of the biggest firms like where Shelley Natenberg works for Chicago, they were trying to actually just do it for themselves, create with really smart guys and a lot of resources in it, and they couldn't do it either. So no, can't be done.
Right. See, going back earlier, you give the news about SoftBank's heavy purchase of tech stock call options. How valid is the historical put-call ratio trends?
Okay, I'm not exactly sure what they have to do with each other, but their buying of options and those other guys forced those put-call ratios, and by other guys I mean like Robinhood accounts, forced the put-call ratios down to those 16, 20-year lows. If they hadn't been there, there would still been a lot of call buying. The market was going up, and so eventually we would have gotten a local minimum as we have, and we would have gotten a sell signal. Just would have been from a maybe not as low a level, but I don't think they changed the necessary timing of the sell signal at all. Just the level at which it occurred, and we used the level to indicate that it was extremely overbought. But if I got a sell signal anywhere as a local minimum there, it would have been a sell signal, whether or not it came from this level or not.
Gotcha. This one I think you can answer fairly simply, but it was a good question if people are new to options. Calls and puts can be bought or sold, but how is that inputted into the equation of the put-call ratio?
Okay, so we don't make any distinction. It's just volume, and so there have been some attempts to try to quantify call purchases taking place on the offering side of the market and call sales taking place on the bid side of the market. Say throw those out. I've seen that data. It doesn't give you anything that's unusual. What typically happens is just all the buying and selling is kind of noise, and when the speculators get revved up, and like recently they were revved up on the buy side, they'll force the ratio out of the normal noise range down to a level where then you get the local minimum. Or in March, the put buyers got it revved up to where it went outside the normal noise range and formed a local maximum, which is a buy signal. So yeah, I know that there is a lot of volume going on that's not speculative, but hopefully that's mostly just canceling itself out. And it's the speculative pushes that drive these signals. And you can see from the chart, I mean, they've been pretty good signals.
Mm-hmm. Yeah. All right. What type of hedges are you putting on for protection in the current market?
So there's 2 different things. Like in our managed accounts, I said where we do some selling of S&P options, not generally put options. We buy VIX calls as a hedge. There's formulas for that and everything. So that's one good portfolio hedge. Now VIX is kind of expensive right now, but as I showed you from that one chart, it could easily get more expensive. So we're buying short-term VIX calls, so you have to keep rolling them over. If you buy them too long, they're not going to respond well to if VIX does take off to the upside. And the other hedge is you can use S&P puts and put spreads as well. I just think that the VIX hedge, when things really get bad, like they got in March, the VIX hedge works a lot better.
Right. No, good answer. What is the typical delayed time the computer program determining the buys and sell signals on your chart?
Right. Okay. So by my definition, if a peak, let's say a peak forms on the put-call ratio chart, which would be a buy signal. If that peak lasts for 10 days, then that's a buy signal no matter who's saying what. Unfortunately, 10 days could be a long time in option trading. So the computer program in general will advance that, and we should get a signal within 1 to 4 days. As I said, the big one at March in the S&P, we got it one day after the bottom. And I also showed that Microsoft chart where it didn't come till 4 days, and by that time the stock had already moved so much I didn't want to chase it. I should have chased it, but I talked myself out of it. So 1 to 4 days.
Gotcha. All right, I'm going to lump a couple here together. Any thoughts on gold, on Barrick Gold, Bitcoin, or crude?
Well, interesting. So we're, we run put-call ratios on all of those, and none of them are giving a signal at the current time. We did have a pretty good, bearish signal in crude a while ago, but we haven't been in anything recently. We were going to get more heavily involved in the Bitcoin area because there are trading options on some of these other Bitcoin exchanges, and we've found a data source. So we're going to start that soon, putting together put-call ratios on Bitcoin, but I don't have one right now.
Sure. No, and good data is hard to come by, so that's I do understand that issue. What option strategies would you use in September 2020?
Well, speculatively, I showed you a bunch of sell signals, so we're buying S&P put spreads on those. And we have the one buy signals, we're buying a call bull spread on those. Things that depend a lot of times on events or low volatility, events or selling naked options, things like that. Those strategies are kind of out of favor right now because volatility is so high that it distorts your back testing, your data on those things. But one strategy that we've been using for pretty good success recently is calendar spreads, and we're recommending those in the daily, the Option Strategist newsletter. We've been recommending a number of those. And by the way, if you subscribe to the Daily Strategist, you also get the Option Strategist, which just comes out once a week. But so we've had some pretty good successes. We just took one off in this FMCI, which is a SPAC that's going public with a company called Tattooed Chef pretty soon. And we're actually going to be getting more into SPAC trades as well. But in a market that's this volatile, speculation is probably mandatory, I would say. A lot of times the market is wandering around and not very volatile. Speculation is just kind of ho-hum. But this market, you got volatile in February and it's just stayed volatile. So that's good for speculation.
Absolutely. Here's one I passed over. Sorry to the writer of this one. Is it important to check the VIX to historical volatility of the S&P?
Well, one's forward looking, one's backwards looking, but yeah, they do have to line up eventually. So that's that one chart I showed there, the futures price, which had that red line sticking way up high. That's the futures price. That's VIX. That's VIX futures. That's the real thing you can trade. You can't trade VIX, but you can trade VIX futures. And then subtracting off the actual current volatility of the S&P, which is extremely low. So something has to give. And from the 2 data points on that chart, we found out that what gives is usually S&P, not the VIX futures. But a system based on 2 data points is not going to hack it. But we do keep that chart all the time. You look at it most of the time, it's not telling you much of anything because the VIX and the 20-day, VIX is a 30 calendar day look forward measure, and the 20-day historical volatility is basically a 1 month. They're both a month looking backwards. And eventually, as I showed from the very last chart, VIX is a little bit too high most of the time, but not so high that it's significant.
Cool. That's Good answer. How would someone track and determine liquidity of stock options and implied volatility?
Okay, so we have a data area on our website called the Strategy Zone, which is very cheap. It's less than $200 a year, and we put about 650 put-call ratio charts up there every day, and sometimes as many as 2,000 implied volatility charts. So you just go there and you look, and you can see that where options are priced currently and where they've been priced over the last year or so. And if you don't even want to spend that, there's actually a free data file that we update on our website every Saturday, which shows the historic volatility going back 10, 20, 50, and 100 days, and then the implied volatility and where the 95th, or I think the 90th, 95th, 5th, and 10th percentiles of implied volatility are. And again, from that, you can get a sense of where the options are expensive or cheap.
Gotcha. How would you calculate the probability of success in a stock option?
Historic back testing, I would say.
Right.
I mean, because we're trading systems, so I have data, extreme data reports on those. But if you're talking like a strategy, like let's just say selling naked puts wins a huge percentage of the time. It wins 92 to 95% of the time, but every loss probably takes out 6 winners. So it is not returning a profit concomitant with that, but still, that's a statistic. But if you talk about speculation, it doesn't make any difference which option you buy, as long as you buy one that behaves like the underlying, and then your speculative strategy's got to carry the day. The option is not going to make money if the stock goes down. The call option is not going to make money if the stock goes down.
Yeah. No, good answer. It's much more about the strategy and the system than the specific data like that. Let's see. SPX bull put credit spreads hedge with the nearest VIX long calls ? I'm not sure what that's even asking.
Okay,
yes.
Let me think about it. So we're doing a bull put credit spread. So we're selling a credit spread on SPX, is that what you said?
Yes.
And hedged with what?
The VIX long calls.
All right. Yeah. I mean, that's not a whole lot different than what we're doing on our managed accounts. We have what I think is kind of a sophisticated way of doing it, but yeah, that works. So you're taking in you're taking a credit from selling the put spreads. You don't spend all of that credit on the VIX calls, but you buy some VIX calls. And then if everything expires worthless, you still have a credit. You make some money. And if the market goes down and your credit spreads get in trouble, your VIX call should be making money as a hedge. And if the market goes up and you lose on your VIX calls, and it's just they all expire worthless, and you should make your credit. The hard part comes there when things get really, really nasty and you've got to make some decisions in the firing line. Just, try to do it calmly and cool-headed and not panic, that's all.
Right. They said thank you for that answer. Kind of down that vein, what's the impact of holding a situation like that until expiration? Or would you be trading out sooner?
Yeah, no, I mean, I'd probably hold it to nearly expiration. I mean, yes. Look, if you sell a credit spread, let's say you sell a credit spread for $1, I don't just make up a number, and now it's trading at a nickel. I mean, what are you going to make? You're probably better off to cover it at a nickel and go on to the next trade. But I mean, if it hasn't really matured yet, and you still got some profitability in it, I don't mind holding to expiration.
Right. One does ask, is there a minimum for your managed accounts?
It's $100,000 minimum.
Okay. Cool. The only other question, which I've seen many times, is there a replay going to be available? The answer is yes. You should be getting an email from NAAIM or from Susan. It should be up tomorrow, I believe, and you'll be able to get it there. It'll also be posted on the NAAIM website probably tomorrow as well.
Right. And if all else fails, you can get it from us too. So
absolutely, yeah, they can get us.
Well, I don't have a recording necessarily, but I have the PDF.
Yeah. Cool. So I think we're good there. Anything else you want to finish off with, Larry? Here.
And now I pretty much told you everything I know. So
Fantastic. Well, thank you for being here today. We appreciate it a lot. And thanks for everybody who attended today. Coming up in 2 weeks, we have Ben Phillips on Wednesday, September 23rd in our webinar series. That's going to be a political talk going into the election and how to position models. Don't forget you can get CE for this today. If you have a CFP or a CMT, get in touch with us about your CE credits. Let's see. Don't forget you can get $100 off NAAIM membership if you join today from our links. There's a link in the side here, and you'll also get an email. That's it. Thanks for being here. Thank you, Larry. Appreciate it, your time, and we'll see everybody next time. And thank you so much.
all right, great.
All right. Bye, you guys.
See ya.